Welcome to the Deep Dive, the analysis designed to give you the context and clarity you need on the biggest market events.
Today, we are jumping into Macy's, Inc., ticker M.
That's right, we're dissecting their Q3 2025 earnings call, which hit the wires pre-market on December 3rd.
And this one was a classic case of market paradox. It's really why we wanted to cover it.
A paradox how?
Well, operationally, the quarter was a home run. I mean, Macy's delivered arguably their best fundamental performance in years. It was total validation for their new strategy.
But the stock didn't react that way.
Not at all. It dropped about 4% pre-market and then finished the day down over 1%.
So you've got this friction point. The past looked fantastic, but the future maybe looks a little cautious.
And then the market decided the future mattered more.
So our mission today is to dig into the quality of that Q3 beat and then try to figure out what exactly was in the Q4 outlook that made investors hit the pause button on this rally.
Let's start with the results because they were genuinely shocking to the upside, I mean.
Yeah, they posted a monster beat, right? Top and bottom line.
A monster beat. It silenced a lot of the critics who thought this bold new chapter strategy was just corporate speak.
Okay, so let's hit the headlines. Start with the bottom line, the EPS.
Right. Adjusted earnings per share came in at a positive 9 cents.
9 cents. Now, that might not sound like a lot, but you have to look at the expectations.
Exactly. The Wall Street consensus was looking for a loss of about 14 cents.
A loss. And the company's own guidance was even lower, wasn't it?
It was. They had guided for a loss between 15 and 20 cents.
So wait, they didn't just beat the guidance, they swung from a projected loss of, say, 18 cents to a 9-cent profit.
It's an almost 30-cent positive swing in this retail environment. That is a staggering execution.
Truly staggering. Did that momentum carry over to the top line?
It did. Net sales were $4.7 billion. That beat consensus by about $150 million.
Okay, but I did see that total sales were actually down year over year, just slightly.
Right, down 0.6%. But, and this is the key thing for you to understand, that was completely planned.
Because of store closures.
Precisely. Management was very clear that the decline was entirely due to them closing underperforming stores. They're shrinking the footprint to improve the quality.
So a small dip in total sales isn't necessarily a bad thing if the stores that are left are performing way better.
And that's exactly what the comparable sales number shows.
Which brings us to the pivotal metric, the comps. How did those look? The market was bracing for a decline here.
The comps were the real story. Comparable sales, which they measure as O plus L plus M.
Owned, licensed, and mobile sales combined.
Right. They came in at positive 3.2%.
Wow. And what does that number mean in context for them?
It was their strongest comp growth in 13 quarters. 13.
Okay.
And it completely reversed the expected decline of about negative 0.6%.
So there's genuine traction there. The customers they want to keep are spending more.
It's proof that the strategy is starting to work.
Okay, so those numbers are undeniable. But let's get into the how. What specific levers did management pull to get this done?
Well, the strengths really came from all three pillars of their turnaround strategy. First up was what they call fleet reimagination.
This is the Reimagine 125 cohort of stores they've been reinvesting in.
That's the one. Those specific 125 locations saw their comparable sales grow 2.7%.
So the money they're spending is actually generating a return.
A clear one. Those reinvented stores are significantly outpacing the rest of the Macy's stores. It validates the whole idea of moving to a smaller, stronger core.
Now, this is where I think it gets really interesting, especially with the whole K-shaped recovery narrative, the luxury side.
Oh, it was a saving grace. The second major driver was the luxury segment. The performance of their high-end brands was just phenomenal.
Give us the numbers. How did Bloomingdale's do?
Bloomingdale's comparable sales were up a massive 9%, 9.0. Just like the core Macy's brand, this was Bloomingdale's best comp in 13 quarters. This shows you the high-end consumer is still spending, and spending big.
And their beauty brand, Bluemercury.
Bluemercury comps were up 1.1%, which extends their positive streak.
Yeah.
So the lesson here is pretty clear. In this environment, you have to own that high-end consumer.
Beyond just selling things, they've also been focused on other revenue streams. How did the credit card business do?
It did extremely well. Credit card net revenue surged 31.7% year over year.
Wow.
To $158 million. That is a massive injection of high margin profit.
Okay, so a huge buffer. And what about the media network?
The media network was flat at 42 million, but the credit performance more than made up for it.
All that success on the top line should feed into profitability. So let's talk cost discipline, SG&A.
Right. Selling, general, and admin expense, it actually declined by $40 million year over year.
So they're getting more efficient.
They're leveraging their fixed costs better. The SG&A ratio improved by 90 basis points. All of that execution flowed down to their core adjusted EBITDA margin, which improved to 5.6%.
Okay, so great execution. But every retailer is fighting outside pressures. Management mentioned tariffs. How do they handle that?
This was really impressive. So gross margin came in at 39.4%, which was down just 20 basis points.
Okay.
But management said the tariff headwind alone was 50 basis points of pressure.
So if you strip out the tariffs,
Their underlying margin actually would have expanded by about 30 basis points. They were selling better stuff at better prices.
how do you mitigate a 50 basis point hit from tariffs? That's huge.
At a multi-pronged attack, they mentioned shared cost negotiations with their vendors.
Basically telling them to eat some of the cost.
Exactly. And also getting discounts from other vendors and then strategically raising prices on certain items. It shows the power of their scale.
So we've got a clear story here. Massive earnings beat, strong comps, luxury is on fire, and they're expertly handling macro pressures.
Check, check, and check.
Then why on earth did the stock pull back? This is the core disconnect we talked about. What did they say about Q4 that spooked everyone?
The market fixated completely on the future guidance. And that guidance was, well, deliberately cautious.
The stock had run up so much, anything less than a blowout forecast was going to cause some selling.
That's it. And management's tone on the consumer changed. They said that post-Black Friday and Cyber Monday, things got a little shaky.
What was the language they used?
They described the consumer as choiceful and selective.
That's classic corporate code for people are pulling back.
Right. They pointed directly to inflationary pressure on discretionary spending. It implies they saw a clear drop-off right after that big holiday weekend.
And how did that caution translate into the actual Q4 numbers they guided for?
Directly. The Q4 adjusted EPS guide was 135 to 155.
Which was kind of low to in line with the street's 155 estimate.
Exactly.
Yeah.
But the real concern was the comp guidance. They said Q4 comps could be anywhere from down 2.5% to flat.
A potential negative comp in the all-important holiday quarter, that's the opposite of what a rallying stock wants to hear.
That's the rally killer right there. And even though they raised the full year guidance, it wasn't enough.
Yeah, tell me about that. They raised full-year EPS to $2 to $2.20.
They did, but they also threw in a bit of a caveat. They noted that the new guidance included a reduction in expected gains from asset sales.
A non-operational item.
Correct. Which affects the annual EPS by about 7 or 8 cents. So basically, they just rolled the Q3 beat forward. They didn't raise expectations for Q4 at all.
Deliberate prudence, as you said. Let's connect this to the investor context because the stock's run-up is so important here.
It is. The stock was up 38% in the 3 months leading into this call. When you have a run like that, the bar is set incredibly high.
So the pullback wasn't really a punishment, it was profit-taking.
It was smart investors locking in those hefty gains. Management gave them the perfect, rational excuse to sell by sounding so cautious about the holidays.
It sounds like the skepticism about the turnaround's durability is still there.
Oh, absolutely. The analyst consensus is still basically a hold. The question isn't, is the strategy working? Q3 proved it is. The question is, can it keep working if the macro environment gets really tough in 2026?
The market needs to see proof of endurance.
That's the word. And they did try to reinforce their commitment to shareholders.
Right, the buyback.
Yeah, they bought back $50 million worth of stock in Q3, and they still have $1.2 billion authorized. But, you know, for a stock that's up that much, buybacks alone aren't going to hold the line against cautious guidance.
Okay, time for our segment. This is not financial advice. We dive into an outrageous but plausible trade idea based on our deep dive.
And the required disclaimer, we are providing analysis, not advice. Do your own homework.
Of course. So what's the idea?
For me, it all comes back to the massive, persistent outperformance of the luxury assets.
Bloomingdale's.
Bloomingdale's at plus 9% comps, Bluemercury with its positive streak. These are performing like entirely different businesses from the core Macy's store.
And management has fought off activists before who wanted to spin those businesses off.
They have. They argue the three brands are stronger together. But that performance gap just keeps getting wider. There's so much latent value there that the market is just not giving the stock credit for.
So if the market isn't valuing the sum of the parts correctly, what's the trade?
The trade idea is a long-term structural bet on the eventual spin-off or sale of those luxury assets.
So you buy Macy's today.
You initiate a long position now, predicated on an unlocking event down the road. The thesis is that renewed activist pressure, or even just management realizing it themselves, will eventually force them to monetize Bloomingdale's and Bluemercury.
You're essentially buying the core department store business for cheap with a free call option on a high-growth, high-margin luxury engine sitting inside the company.
That's a great way to put it. You're buying the stock today, anticipating a sum of the parts unlock. And this quarter's massive comp beat from Bloomingdale's just proves how desirable a standalone asset it would be.
So let's wrap this deep dive up. Macy's delivered an undeniable operational beat. The strategy is working.
It is. But that tactical caution in the Q4 guide, combined with the stock's huge run-up, created a rational, short-term correction.
The turnaround feels credible, but like you said, the market demands proof of endurance, not just one quarter of momentum.
And the job of proving that starts right now in the most important quarter of the year.
Which leaves us with the final provocative thought for you to chew on. Did management's caution on the Q4 consumer effectively set the bar low enough for them to deliver another surprise beat?
If that holiday season is just slightly better than their worst fears.
Could the stock snap back just as violently as it pulled back?
An excellent question to ponder as we watch those numbers roll in.
Thank you for joining us for this deep dive into the Q3 2025 Macy's earnings call. Continue your learning journey with us next time.